Okay, welcome back to Chapter 12. We are on page 2, and this should be your third video. So, we're going to look at the fund accounting, go through a little bit of theory, then we're going to get right into some examples. So, fund accounting, and this is optional, by the way, can use non-fund accounting. So, in this method, accountings are broken into funds, even if the physical assets are not separated. So, you could have your cash all in one account, but it might be separated into $10,000 in our future building fund and $10,000 in our general fund, and then $100,000 in endowment. Usually the endowments, though, are kept separately because they are so restricted. Okay. When I first started at my first, I was controller of a school district, it had been smaller and then it had amalgamated and had gotten bigger. And so some of the accounting procedures hadn't really changed. So I got there, and now, bear in mind, this was many years ago. So the values were worth much more. But anyway, I got there and I looked at the scholarship and it was, I don't know at that time, 800,000 or something, which now is much larger. And here's me just out of graduate school, have a kid and all that. And I looked into it because you always look into all the accounts and see what happens when you first get your job. And I was the only signing authority on it. It would have been so easy for me to commit fraud had I so desired, because I was the one doing all the reports, doing all the checking and so on. And depending on how it was audited that year or any year, it may not have been noticed. So needless to say, the first thing I did was get another signing authority on it, someone from the board, so that I wasn't the sole holder of that, or that I didn't have sole control over that account. So you want to watch. Sometimes not-for-profit kinds of places can have significant amounts, but they won't have the controls on it that you want. Make sure you have those on, especially if you are the treasurer. That's just my little warning. Don't worry. I didn't take the money. I'm not here from jail. Everything was good. Okay, you can't see my face. I hope you know I'm joking. Okay. So, different funds: university, research funds, scholarship funds, residence funds, etc. In a church, mission funds, memorial funds, building funds, operating funds, and so on. The board of directors, their funds are not restricted, because they can change their mind. Only external restrictions apply for funds. And you can read that. Now, in the past, not-for-profit organizations expensed all their assets, because to the not-for-profit, a lot of it came down to, do we have cash to operate? So if I bought a bunch of equipment this year, that means I had less cash to operate on saving it all up. So they were very much focused on cash in, cash out. That's changed now with the movement to standards. However, only large not-for-profits have to capitalize and amortize their capital assets. If you are a small not-for-profit, so your 2-year average revenues are less than $500,000, you can either expense it right away, you can capitalize and not amortize, or you can capitalize and amortize. It's up to you. But once you cross over, then you've got to put it on your books as a capital asset. And I'll show you when we do the example. Okay. As an amortize prospectively. The earlier version of the notes and the recording said retrospectively. Retrospectively was for when the standard first came about. I hope that clarifies things. Now, contributions. Basic two types of revenues. Contributions coming in from the outside, so donations, grants, or other types. Investments. Sale of goods and services. For example, CA, they're called the Edmonton Humane Society now. They not only take care of the animals, but they have a little store that sells, dog food and all that kind of stuff. So that's more money that's coming in. And that would be treated just like a normal entry, right? So cash and revenue, cost of goods sold, and inventory. Now, the handbook defines three kinds of contributions: unrestricted, restricted, the external contributor sides, and endowments we've talked about. So, unrestricted reasons, someone comes to the door or gives you a call and you donate to a not-for-profit organization like the United Way, and you might just say, no, use it where you want. That's unrestricted. However, often, especially the larger ones, give you an option. So, for example, I went to the U of A, and every year they send a little note in the mail that says, would you like to contribute? And they give you options. So I could say my contribution only goes to, or I can say it only goes to sports, or only to the new building. So that would be restricted. And then endowments, of course, you maintain the principal in perpetuity, and only the interest earned or dividends on the endowments can be spent. They can either be restricted or they can be general. So, for example, the scholarship fund at MacEwan, those endowments, the interest or dividends, definitely restricted. It would be spent on scholarships and nothing else. Other endowment funds could be spent on options. It depends. All depends on what the donor decides. Okay, so we're getting through a bunch of technology here. On to page 3. So the methods of accounting for contributions we've already mentioned are the deferral method, the restricted fund method. If you don't want to use a fund accounting basis, you use the deferral method. And as we saw, it's all under one column. United Way reports on a fund accounting basis. United Way is deferral. Seem to be missing a word. It will use the deferral. Let's put like the United Way statement in Appendix 12A. And then put a period after that. My goodness. If it reports on a fund accounting basis, it'll choose the restricted fund method, which provides a financial statement column for each fund. So, basically, this is what we're doing. Where is fund accounting used? And you have choices. Oh, then we know we're using the deferral method. If it's yes, then we need to know what the reporting objectives are. So this kind of ends here. So if the reporting objective is to focus on the activities, like program A, program B. Then they use the deferral method. If the focus is on restrictions, so for example, you've got building going up, or you're buying buildings or a lot of large scale assets, that's when you'd be more thinking restrictions. If you go with restrictions, you're going to use the restricted fund method. So, with this one, you still may have contributions that are restricted. So if you do, you don't have a restricted fund for it, but contributions with restrictions are deferred and recognized as revenue to match expenses. And we'll see an example of that. With the restricted fund method, makes it a little bit easier because you're never worried about when you should recognize it and have we spent the money and have the conditions been met. You recognize restricted revenue in its fund directly. If there is no specific fund, so for example, you have a building fund, operating fund, and an endowment fund. You have all three of those, but get a check from the Edmonton Arts Council. And they say you can only use this for renting the theater for a show next year. Well, you're only getting that one check from them, right? So there's no reason to make a specific whole fund for check that comes in every year. So if there's no specific fund set up and you don't need one, defer that revenue until the expense is incurred. Okay, and we're going to go through an example of each of them. Okay, I'm going to pause here because I've got about a 14-minute time limit on my recorder here before it starts a new file. So I will start with the restricted fund method in the next video.